Welcome to Livewire's top-rated fund series. I'm Ali Selby, and today I'm joined by industry heavyweight David Wright from Zenith. Thank you so much for joining me today.
Thanks for having me, Ali.
First up, I'd like to talk about the investment topic or theme that you and the team are spending the most time discussing right now.
Well, probably the biggest one, and it's not terribly unique, is the emergence of inflation and whether that gets out of control further than what the central banks are looking at. That has very wide-reaching implications if that's the case.
What do you and your team think?
Well, I think anecdotally, and I'm not sure whether you've found the same through your business and experiences in Sydney, but certainly there's definitely wage inflation in financial services. And I guess you understand that because the markets have been so strong. We've got a couple of guys in the office building houses. You can't get tradespeople. We're employing at the moment, not just in the analyst roles, but in admin, in IT development. The labour market is very, very tight. So it's kind of hard to see that inflation's not emerging in the economy. And I know that the Reserve Bank and also the Federal Reserve have spoken about expecting a blip of inflation and then being able to control it. We're probably not so sure about that. So that if it does overshoot, you have potentially larger moves in bond yields. That's not good for equities. So that makes a pretty challenging investment environment if that kind of plays out and surprises on the upside.
You touched on it just then, but how does this inflation impact the way that you're constructing portfolios?
Yeah, and so the reason for your original question is key because there's a number of implications for portfolios. The first being, I suppose, in the defensive component of portfolios. As we know, pretty much since the GFC, the duration of the fixed interest benchmarks actually got longer because both governments and corporates have been taking advantage of the low interest rate environment and issuing longer dated bonds. That's benefited a lot on the way down, but it's at real risk of capital losses on the way back up. So certainly within the defensive component of portfolios, we want to keep at the moment duration of fixed interest managers and combinations short. And in the equity side, as we've already seen, quite a rotation out of, growth style managers into value, with value or the sort of economic rebound really suiting value managers rather than growth. You want to make sure that you've got the mix of managers right in both Aussie equities and your global equity sleeves of portfolios. So. As I say, it's a great question because it has big implications for how you construct portfolios.
So it's about being really diversified then?
It is, again, a good point. What we find in times of market stress is that people gravitate back to what they know. And so generally, portfolios become less diversified. And yet in an environment where, most of the sort of public markets are expensive, and you need to be going wider and broader to generate sources of return. We found that a lot of portfolios have become less diversified. So a lot of people have lost patience, as an example, with alternatives. We think going forward that's going to be a place where you're going to need to invest in to generate returns and help protect portfolios if you have sideward moving or worse still, downward moving equity markets.
You said before that markets are looking quite expensive. Where do you think we actually are in the market cycle?
Well, I think, if you say the full extended market cycle is kind of euphoria, I don't think we're there yet, given, the outcome and...
Even with what we're seeing in cryptocurrencies right now?
Good observation. Look, I think cryptocurrencies are a market that is heavily influenced by retail investors. And part of the reason for that is it's a developing market. It's not yet a deep market. It's not yet a massive market like, obviously fixed interest government bonds and the major equity markets and even currency markets. So it is prone to, social media or media, as we've seen with Elon Musk's statement more recently. Yeah, exactly. So I think you're right. Like there's definitely been more retail participation in markets through the COVID crisis for a variety of reasons, which we can talk about if you wish. But certainly, as you said, the cryptocurrencies are one of those. But I think there is still concern. So that's why, by professional investors, about the economic rebound, about potential higher inflation, about the sustainability of the economic rebound, that I don't think we're quite at the euphoria stage of market. So it's certainly optimistic, and that's, as you know, Ali, been played out in terms of, consumer sentiment and business sentiment's really very strong, certainly here and in the US, not necessarily in all parts of Europe.
Is it possible you could please share 2 investment themes or ideas that you think will be really important to investors' portfolio returns over the next 5 years?
Yeah, so one outside of what we've just spoken about in terms of, I guess being very conscious of what inflation does is certainly the whole ESG space. And again, that's not terribly unique. It's been around for a number of years, but in our experience, in the last 6 or 12 months, that momentum has shifted enormously to the extent that there is much more focus both by investors, advisors and fund managers and what they're doing from ESG assessment and practices perspective. So we've already seen, I think, examples both ends. So examples of companies that are following, let's say, good environmental practices and being bid up. And so they've really performed very well from a share price perspective because they're seen as sort of ESG type leaders. To the opposite extreme of where, I guess corporates have done things that haven't been socially acceptable and so have been really punished by the market. So, I do think that plays out pretty strongly from here on in, and certainly in the time frame you're talking about, the next 5 years. So that's a big one, I think, that has big implications for how money's both managed and invested.
When investors are looking at this theme, how do you recommend they avoid the greenwash?
There's a lot of greenwashing.
So there is.
So that's unfortunate. I think a lot of the market, both corporates and professional investors, are obviously, very acutely aware of the whole ESG dynamic, and so everybody's kind of trying to piggyback off that. And as you said, you really have to be careful of cutting through the rhetoric and getting to the heart of the matter and seeing that, what people are doing both in companies but also in professional funds management is actually real, and that it's not just lip service to the environmental or social or to be honest, governance is evolving, but I think it's really the E and the S factor, so environmental and social, that is evolving the most. Governance, if you haven't been doing and following strong governance practices, let's face it, for probably 3 decades, you're kind of nowhere. So whilst yes, that'll continue to develop, it's really the environmental and social that's developing the most quickly, and we need to sort of cut through and see what people are doing is real.
Are there any funds in particular that come to mind that really play well into that theme?
Well, I think there's, we have seen dedicated ESG funds, or the number of dedicated ESG funds in Australian equities, international equities in particular. Literally, there's only a handful of green or ESG bond or fixed interest funds, and then really not much at all in REITs, alternatives. So when you have clients asking us to construct ESG portfolios? At the moment, our answer is we'll do our best, but you actually can't cover every asset class because there's not dedicated funds. So going forward, it's going to be expected. It's not just going to be specialist ESG managers.
Is there any two that you think, that you could name for us today?
Well, I think here in the Australian market, let's face it, Pendle's been probably at the forefront of that, having a dedicated ESG business that they acquired within the group. Managers like Impacts, which is now coming into the sort of Fidante suite. You've got PIMCO, obviously the largest global bond manager in the world, having a global ESG bond fund, but also it's been quite a specialist field. So you've seen some of the smaller managers sort of evolve and be really successful in acquiring, funds and interest from investors.
Yeah. What's one underappreciated asset class that you think will be really important to investors' portfolio returns in the future?
I think it's definitely alternatives. So when I talk about alternatives, it's really sort of, market neutral, global macro, managed futures, sort of multi-strategy funds that have not kept pace, and to be fair, they were never going to keep pace. They're not designed to keep pace in, roaring equity markets. And we've had mainly, one directional market since then. So all of a sudden now we've got greater volatility, we've got greater uncertainty. We've seen through COVID that whole industry sectors are basically almost been closed. So the environment for active management in general is much, much better than it was. And if we have, as I mentioned before, corrections as a result of inflation overshoots and bond yields spiking, equity markets correcting, that's really where your alternative managers are going to come to the fore.
Are there any managers in particular that have really impressed you?
Well, I think, from a market neutral perspective in the Australian space, there's managers like Firetrail have done an excellent job. Man AHL, we're using portfolios for managed futures. Janice Henderson, sort of multi-strategy fund. Managers like GMO and Graham in global macro. So they're all, lumped into like all the alternatives asset class, but all offer very different investment strategies that don't rely on markets appreciating all the time to generate returns for investors, and also at the same time are able to protect on the downside. So that's, I think, going to be very important going forward.
And just finally, what is one piece of advice that you could offer yourself early on in your career that would help you pick good managers consistently?
Yeah, I look back at that now, and one of the things that was kind of drilled into us at the start of my career was key person risk is bad. You don't want fund managers with key person risk. It needs to be spread across the team. You don't want that key person leaving. I've gone full circle on that through my career, to the extent that, in my view, you actually want key person risk. Why do you want key person risk? Because that suggests that you've got extraordinary people managing the money for you, and if they're not there, if they leave, you leave. So I think that's definitely something I've gone full circle on from the start of my career. If you've got multiple key people, extraordinary people managing money, that's terrific in a funds management organisation, but respectfully it's quite rare. So in a lot of the premier successful managers and funds that have generated well above average returns for investors, it's usually as a result of a really fantastic key person. So you want key person risk.
How important is having a manager with skin in the game?
I think it's hugely important. There's nothing like managing your own money to, make sure that you're fully focused.
Yeah.
So, that's a key question that we're asking fund managers when reviewing them. And I think, investors should be, for those that do invest in their own funds, investors should be comforted by that. For those that don't, it's probably a bit of a alarm.
Well, David, it's been an absolute pleasure to talk to you today. Thank you so much.
Great, thanks Ellie, appreciate it.